it's possible that we will have what I hope would be a mild recession.
Well, breaking financial news. First Republic Bank will be seized by the FDIC. That's according to Reuters.
For most of this century, with growth rates far below our historic average.
More than one large reserve currency. There have been times.
A group of American banks now creating a $30 billion rescue package to save First Republic Bank.
Fed just raised interest rates again and all but confirmed we're headed towards a recession. In this video, let's talk about all the factors impacting the downturn in the economy, what this new interest rate hike means for you, and at the same time how the Chinese yuan has surpassed the US dollar as China's most used cross-border currency. But first, we need to talk about yet another bank collapse, right? This is a situation that just continues to get worse. In order to understand how First Republic collapsed, we need to go back to the start of it all, which was the collapse of Silicon Valley Bank. Some additional context here. When Silicon Valley failed, they were the 16th largest bank in the United States and the second biggest bank ever to fail behind Washington Mutual back in 2008, which at the time had $188 billion in deposits. First Republic was the 14th largest bank in the US when it collapsed, with over $212 billion worth of assets at the end of 2022. The Silicon Valley collapse created a chain reaction that severely impacted the regional banks and First Republic. This led to an unprecedented bailout by some of the largest banks in the United States. But even after all that, First Republic was still unable to recover from them. In a recent earnings report, they announced that they had lost over $100 billion worth of deposits after their customers had lost faith in the regional banking system. Soon after, the government had to bail them out, and they put First Republic's assets up for auction to the highest bidder. All reports indicate that it came down to JP Morgan and Bank of America, with JP Morgan ultimately coming out on top. It's important to reiterate that JP Morgan only acquired their assets, not their liability, which is quite frankly unheard of. According to reports, JP Morgan paid only $10.6 billion for First Republic, but in return, it's getting about $92 billion worth of assets in the deal, which includes the $30 billion that them and the other top banks gave First Republic to help try and save them. Seems like the steal of the century, if you ask me. But now, JP Morgan is holding 17% of the total deposits here in the United States, totaling $17 trillion. Do you think it's smart to have one bank with that much market share? Let me know down in the comments. Speaking of $17 trillion, you know who doesn't have that many dollars? Well, me, but also China. Because just recently it was reported that the Chinese yuan has overtaken the US dollar to become its most used currency in its cross-border transactions for the first time in its history. With countries like Russia, Brazil, Argentina, Iraq, and Bangladesh accepting the yuan for Chinese imports, the yuan was used in 48.4% of its cross-border transactions, while the dollar share declined to 46.7%. So while this sounds terrifying, and most people's immediate reaction to this might be panic, here's why it's not as big of a deal as you might think. Yes, it's true that the yuan is growing in popularity, that China's making strong partnerships with countries all around the world, and that the BRICS countries do pose a threat to the US dollar at some point in the future. But the truth is, the Chinese yuan represents such a small percentage of the usage around the world. According to financial data from SWIFT, the yuan share of the global market is 4.5%, compared to 83.7% for the US dollar. So for now, this shows the current dominance of the dollar and its position on the global scale as the world reserve currency. For a deeper dive in how the BRICS economies are actually impacting the US dollar, I made a video about that specifically, and it should be popping up on the screen now. Let's transition back to a story that's a little closer to home and talk about the Fed's most recent interest rate hike to 25 basis points. For quick context, 1 basis point equals 0.01%. So the 25 basis point increase by the Fed means they raised the rates 0.25%. This move brought us one step closer to what's known as the terminal federal funds rate. This is simply the highest interest rate that the Fed expects to hit before eventually reducing the interest rate and coming back down. And as of this announcement, we hit that rate, which was between 5 and 5.25%. More simply, what this all means is that the Fed thinks that they're done with rate hikes for now, and will take a wait and see approach to see if any future rate hikes are needed or not. If inflation starts to come back down, they could hold it here for a little while longer. to see, in fact, if their plan is working out or not. Overall, the Fed update and the Jerome Powell press conference suggests that everything's moving in the direction that they had anticipated. They've done everything that they can as of right now, and the rest is going to rely on the US economic data over the next few months. If you like these personal finance news update videos and want to see more of them, make sure to subscribe to the channel. Personally, what I see going forward, at least for the next few months, will be less lending, more strict financial policy, and unfortunately more bank failures. The banking industry right now is in a whole lot of hurt. Besides all the bank failures that have already happened, including Silvergate Bank, Signature Bank, Silicon Valley, and now First Republic, there might be more to follow, as PacWest Bank and Western Alliance Bank are currently looking for a buyer because they don't believe they can sustain themselves much longer. Additionally, TD Bank backed out of a deal to buy First Horizon Bank, citing regulatory failures. All these things will likely lead to a slowdown in the economy. Not great, but it can hopefully reduce inflation so that the average American can get back to having discretionary income, which is pretty great. So now let's talk about how all these news stories around the US dollar, the banking crisis, and the interest rate hikes impact you, and what you can do to put yourself in the best possible financial situation. Since all these things right now are truly out of our control, personally, I'm gonna keep sticking to the basics, which means utilizing my monthly expense budget and living within my means, continuing to invest consistently into the market, mostly in broad market index funds, which I don't plan on touching for the next 20 to 30 plus years. Boring, I know. But it's been proven time and time again that no one actually knows what the market's gonna do. So don't let short-term news impact your long-term financial goals. Since the Fed just confirmed a recession, I think it's important for you to know that there's actually ways you can successfully invest during a recession, which I go over in this video here.